is Investor's Guide. Thank you for tuning in. The show that will actually hold your hand when you invest your money and stay till we see results from those investments. Remember, we've been here for 8 years helping you with your money, and this week also we'll first figure out if you should make any changes to your portfolio post-budget in the new financial year. We'll also take a look at the HDFC Prudence fund. We'll help an investor figure out whether or not he should sell property and invest the proceeds in different asset classes. Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show this week.
Thank you.
Of course, we have to talk about the changes that were announced in the budget announcement. There was some tweaking really of tax slabs for those at the bottom of the pyramid, but technically for the larger, salaried middle class or the larger investor who uses SIPs, there wasn't too much of a change there, was there?
No, there was hardly a change, and I think investors should consider themselves in a manner that any budget should not really have any significant impact on the way they invest, the way they save, and this budget was not very impactful, or is not causing any huge difference. The only fear that we had that there could be some tweak in the capital gains tax. There was some, but that doesn't affect the individual investor who invests in stocks or mutual funds.
Well, the big change, of course, was the change in capital gains tax limits for real estate and the change in tax treatment for second homes. Now, there will be a lot of people who were using the second home as a tax benefit because you were able to deduct more in terms of interest. Do you think now a lot of those people are possibly going to consider taking their money out of that investment and moving it to other asset classes? Do you think it would be better utilized in other asset classes?
Not only for just that reason, because all these are actually the add-on reason. These are the supplementary reason. The primary reason why people invest in home is their belief that they can make money or more money with superior understanding, or the belief that they can make more money from their homes or from property. So from that standpoint, the tax incentive which was available, I don't think that is a turning point for anybody's decision. But yes, the very reason that we come across a lot of investors in property who are not making money, their rental yields are low. That is a good enough reason. This will only catalyze the whole decision-making process. That if at all there was a tax break available on the interest payment, or if you borrowed money to buy that home, then that is gone. But I don't think this is going to be the primary reason. The primary reason why everybody should be selling his second home if it is not producing enough return, or the tax break has gone. But I think that is the third reason. I think the primary reason why one should sell a home is that you think that it lacks potential. The house is of a kind that is unlikely to witness significant gains.
All right, so if you have a second home, that's the only thing that's really changed. And like we've been saying, Dhirendra, from the day of the budget, which is basically that the finance minister is telling us that real estate is not an investment. It is no longer an investment option. It is, unless you're buying a home that you want to live in, real estate should be used really for end use or for what we call own use. You should not be buying homes and locking them up, which is what the finance minister is telling us. Technically, Dhirendra, that's what we've been saying on this show for 8 years, that consider real estate, an expense, a housing expense where you're really buying a home to live in. Do not consider it an investment.
Yes, absolutely. Finance minister has used the budget as an opportunity to incentivize all kind of investment in real estate, which will be, consumed, where people will live in. Even greater incentive for the low-cost housing. I don't know, government may be off the mark in terms of defining the low-cost housing or the magnitude or the value of it. But I think the direction is very clear. The message is very clear that consider, incentivizing homes which people will buy and live in that. Provide all kind of incentive for their construction, for their development, but not as a speculative investment. And that is what a large part of our audience have believed in the past. And the faster you square up your positions, the faster, of course, there are serious problems there in terms of delivery, your ability to sell them, and first get your home, first get the possession. But if you are able to put that together, I think it is important that this whole policy change that we have seen has a very clear direction. Don't consider it as a speculative investment. And I think the kind of backlog that has got created in the whole speculative boom phase of this segment, a lot of things combined together looks like, one should give up on this idea, square up one's position, even take a hit or a loss, and just have the home which you plan to live in, nothing beyond that.
Nothing beyond that. And remember, there's another impact that this entire move will have. If people with second homes right now decide they don't want to hold them anymore and they start to offload them onto the market, then real estate developers are going to have to compete with fully ready to occupy homes that are currently available in the market. It will release a lot of supply in cities like Mumbai and Bangalore and Chennai and Delhi within the city, because someone who has held a home for 5 years or more will start to now sell it. So this will add pressure. It will, if you're going out to buy a home, it will give you far more options than what's available right now. It will add further pressure to prices because there'll be more competition in the market from second home owners who are now going to offload those second homes onto the market. All right, let's answer some questions. Bhavji Chawla has written in. He said he's been watching our special program on Budget Day, and he has some things he wants to clarify. He says the tax relief of 12,500 rupees for citizens on their income, will that be available to those who make more than 5 lakh rupees? That's his first question. Second question, senior citizens over the age of 80 years, will they benefit from this as well? Well, there is a senior citizens over the age of 80, what's being called super seniors by the tax department, pay no tax up to 5 lakh rupees. So technically, they were not paying that tax at all. So that benefit, they're not seeing a benefit because that benefit was given to them last year.
Yeah, so a benefit which they were availing anyway before, so they don't stand to benefit from that. But this 12,500 benefits every slab, because our income tax slab works in an incremental way. That for your first 3 lakh rupees, no tax. So even if you are making 50 lakh rupees, that first 3 lakh rupees, you don't pay tax. Then the next slab, and you pay this much tax. And then the subsequent income over 5 lakh rupees up to this much is this percentage. So your 10, 20, 30% tax slabs, they take into account the previous benefits. So it benefits everyone.
So it does benefit everyone. The benefit that the finance minister has given us is a 12,500 rupee benefit per year, translates to about 1,040 rupees per month. But if you make more than 50 lakh rupees, then you are going to pay an added 10% surcharge on your entire income tax amount. It could work up to about 1.5 lakh rupees a year in minimum for everyone who makes more than 50 lakh rupees. That's the tax, added tax burden starting this year. Let's take a look at the portfolio that's been sent in to us. This is a 35-year-old Ranger with no liabilities, no loans. Goal is really a child's education and his own retirement. 35-year-old Dheeraj has written in. He has a 2-year-old child and he wants to plan for his child's future and his retirement. He says he has 9 lakh rupees in his PPF, 10 lakh rupees in a fixed deposit, no loans, and he's been investing 8,000 rupees every month in mutual funds. He wants to know if he should continue investing in these funds or not. Before we get into the funds, I'm wondering why he needs 10 lakh rupees in a fixed deposit. It doesn't really qualify, given the rest of his portfolio, doesn't qualify as as an emergency fund unless he has some particular reason for holding it. Would you recommend he move some of that money out?
Yes, it's understandable, and it is good to have that PPF if you would have spent that money. But PPF may not be a great idea because this is fixed income yielding long-term recurring deposit. And assuming that you are deriving all the tax break by investing in this PPF, you are going to yield, it will get you fixed income and even lower return in future. And you are committing to making this investment over the next 15 years. So if you have been exposed to the SIP, to the equity fund, so I think he should consider moving, maybe contributing or stop contributing to PPF, and think in terms of making a 15-year SIP. Try and understand what happens with equity when you make regular investment over a long period of time, the kind of return that you are able to derive. The perception that equity is risky and you lose money or it is more volatile. But this volatility comes to your advantage when you are a regular investor. You are able to buy low as well as high and over a period of time, and over particularly such a long period of time, the likelihood of losing money comes down dramatically. Or I really wonder that in the worst of Indian funds, if somebody would have invested regularly over a 15-year period, he would have definitely made more return than what one would earn in fixed income. And the worst of fund will be able to beat the PPF return. Yes, the connect with PPF, for generations it has been the trusted savings avenue. It has been the trusted savings avenue for its guaranteed return managed by the government, which our grandparents also had. And at a point when the market was not accessible, so there are a variety of reasons why people like it, or why it still is a very popular thing. But it need not be. Investing for 15 years in PPF compared to a SIP in an equity fund will be a huge missed opportunity, more so in coming times when fixed income returns are going to be very low.
Yes, of course. You remember, if you have a fixed deposit right now, it will mature at some point, and then when you want to put the money back, you'll find that the return or the rate of return is much lower, and you'll be forced then to reinvest at a far lower value. So Dhirendra, they're saying that just keep how much you need as emergency in that fixed deposit and remove the rest and move it into your mutual funds. Dhirendra, let's take a look at his mutual funds. He has the BlackRock Micro Cap. He has Franklin India Blue Chip Fund, the HDFC Equity, and the HDFC Tax Saver, HDFC Prudential Value Discovery. Now, these are all good funds. Would you recommend he just continues, because they're all SIPs he's running right now, should he just continue with these funds? Would you like to make any changes there?
Yeah, I would like him to continue these funds. All these funds combined together make a great portfolio. It will require, some discipline, and also the amount of money which is investing in these funds. There's 2-3 funds which I like. Of course, if he's going to discontinue his PPF, or if he's going to invest very less just to invest less in PPF account just to keep the account alive, then he will have to increase his allocation or the amount of money which he's investing in the tax saving fund. And generally speaking, one should be emphasizing low maintenance, more diverse funds. So from that standpoint, the tax saving fund as well as HDFC Equity and ICICI Prudential Value Discovery, that should account for 60-70% of his money, and rest of the money, also sticking to a plan, and is sticking to his allocation and investing through the lean times, because some funds were doing very poorly in recent times, and if he has continued investing, or as he has continued investing, now he reaps the benefit. Likewise, in future there will be funds which will be doing very poorly. I'm hopeful that, as and when the market gets more turbulent or turns around, or, is not that favorable or in the same frame of momentum as it is today, then the DSC BlackRock Micro Cap can prove to be very unnerving. And it is important that he continues investing even through that period, through a full market cycle. And he has the time for all that. So he should invest more, decide on the allocation, and continue investing irrespective of the state of the market to derive full benefit.
This week we're looking at the HDFC Prudence Fund. I want to give you the numbers and then we'll come back and talk about it.
Thanks, Faye. This week we take a look at the HDFC Prudence Fund. With a 3-star rating on value research and over 16 crore rupees as assets under management, this fund is heavily tilted towards equity despite being a balanced fund. With an average performance in a rising market, the fund has had several ups and downs in the last 5 years. Let's quickly take a look at the numbers. The red line is the fund and the blue line its benchmark. You'll see that the fund has performed better than its benchmark and category over the last 5 years. In the year 2013, however, the fund underperformed its category with a return of just 2%. A quick peer comparison shows that the fund's performance in the last 1 year has been exceptional, with a return of 32%. In the long term, however, several peers performed better than this fund. While the fund's performance looks promising in the short term, its long-term performance doesn't really match up when compared to its peers. So is this a fund you should be investing in? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. In the HDFC Prudence, was a highly recommended fund a while ago. It's currently at 3 stars in value research. It's middling right now, and it used to be a time when Prudence would behave like an equity, a complete equity fund. Do you still have faith in this fund, that it is an aggressive balanced fund that's perfect for someone who just, wants just the right amount of equity exposure?
No, historically, this something happened to this category of fund. Initially balanced fund used to be 51% equity and, about 50-50 equity and 51% just to comply with, the tax laws. Then the tax laws in the country changed, and it said that the tax treatment of equity will be concessional holding of, equity funds or equity for 1 year and more. All the gains will be tax-free. And that definition defined equity allocation at an average of 65%. So this fund, all balanced fund changed towards that. They increased their equity allocation to 65%. So all balanced fund became an equity tilted balanced fund. And this one went, a step ahead. This on an average, HDFC Prudence on an average has maintained nearly 75% allocation to equity. So it's almost like an equity, I would say a fixed income allocation of 25%, equity, a conservative equity fund with a 25% allocation to fixed income. That part historically, now I find that this fund has somewhat changed, but HDFC Prudence still not very long back was heavily into mid caps and small caps, and that was adding to the great volatility, which was not a great which is not expectation of a kind of investor who is investing in balanced funds seeking greater stability. Things have changed. This fund struggled, slipped on the ratings as well. A lot of nervous investors, and this is a fund which has, been liked by investors. It's among the few largest fund in the country, and I think with a large base of investor investing over a long period of time. So now things are changing in this fund. It has improved its performance as well of late. These 2-3 things, of course, the allocation thing is not unlikely to change. It is still perceived, this fund has maintained its allocation, but I think the underlying portfolio has undergone quite a bit of change, and change for the good. I don't know if it is a permanent change or if it's a tactical change for now, but I would consider this as a good fund for somebody seeking stable growth, but not as much as it's still far off from being a balanced fund, a fund which will provide you, which will not unnerve you. Even today, given the 75% allocation, it falls in a different category. I can call it a conservative equity fund, but not of a kind which is conservative, tries to provide you far greater stability that a balanced fund investor will be expecting.
Of course, these are the numbers of the HDFC Prudence Fund. Dhirendra, what would you recommend? What kind of investor should be investing in this fund, and what is your rating for this fund right now? It's hard to really find. Investors don't really slot themselves that they cannot define themselves very precisely. Many investors are comfortable with very volatile. We come across a lot of questions from people who are fine with their DSP BlackRock microcap investment, which might prove to be very disappointing on occasion. But and off late, people are chasing performance. Hard to find a fund. A person who is investing in a multi-cap fund will be able to derive as much return. I don't think the experience of HDFC Equity or HDFC Prudence will be very different. So I think hard to define, but somebody who is not very comfortable with extreme volatility of equity funds, it might be suited for them. It is definitely not a balanced fund given its 75% allocation. And finally, Dhirendra, your star rating for HDFC Prudence? For all its past sins, though of late it has improved quite a bit, or it's showing resilience great performance of late, still I would slot it as a 3-star fund among balanced funds. But just to say that our own understanding and the number of balanced funds available, we will actually be revisiting this category to separate the balanced fund from these equity tilted balanced funds. All right, 3 stars there for the HDFC Prudence Balanced Fund. I'm going to quickly slip in one question before we end the show. Yogendra has written in, Dhirendra. He says that he has a property he wants to sell now. He's a little skeptical about selling it, considering that the fixed deposit rates are very low. So he doesn't know where to invest the proceeds. He's already made a list of mutual funds he's been investing in, but he's not getting any tax benefit on the property as he has rented it out but paid off the home loan. He says, should he wait for property prices to rise and then sell, or sell now and put the proceeds in debt mutual funds? This is definitely, and I will guarantee him, not a good market to be selling a home. You would be selling far lower than the price that you would ideally like to get for it. Also, if he's going to sell the home and put his money in fixed deposits, then he's actually going to lose money over a period of time. Dhirendra, would you recommend that he seems to have only debt mutual funds and fixed deposits as an option here for us. So he's not an aggressive investor. What advice would you give him?
No, the fact that he has invested in a home to generate reasonable return, and that has not materialized. So I would say, I don't know, he's the best person to actually form an opinion on the likely gain potential, or potential gain from that house prices. If it is in a locality where he thinks, or in a surrounding, or in a city where he thinks that things might improve dramatically, or if not dramatically, reasonably, in a year or 2 years' time, then he should definitely wait. Otherwise, I think it's a good idea to get rid of the home, invest conservatively, and the rental yield which one is getting without the tax break, if he has not borrowed money, or even if he has borrowed money but it's a second home. So it will be worthwhile to consider assuming some equity risk, even if you are conservative, because when you invested in this house, you compromised on the liquidity, and which means that this capital is not needed at a short notice, which means it's a long-term money you can invest. And most of the risk that you are exposed to in equity is basically, comes from the fact that it's your short-term money, or you are getting nervous about it. Maybe the way to deal with it is, the way you invest. If you sell this house for 50 lakh rupees, and if you invest in equity at one go, it might turn out to be very risky, because when you see that how price fluctuating every day, it can scare you. But if you spread this money over the next 18 months to 2 years' time, you'll be able to onboard equity with in a more calibrated manner. Then you will also benefit. You'll start appreciating that how equity functions or works. You are unlikely to need this money for next 5-7 years. So this assuming this risk in a measured way, and maybe not invest in an all equity fund. Maybe consider a balanced fund. Consider a fund which is unlikely to decline in value in a brief period of time substantially. So these are 2-3 things. If you do, you will be able to get on board. And your goal should be to beat inflation and beat fixed income return. More so in cases where you are going to definitely settle for low liquidity, or you don't need the money for next 5-7 years. And I think this is the kind of money which should be invested in equity. Embrace it.
Okay, Dhirendra says embrace the money in equity. My advice for you is slightly different. First, consider the long-term capital gains tax you are going to have to pay. So first, bring a tax advisor in. Take a look at how much tax you're going to have to pay depending on how long you've held the home. Now, you will have to anyway either reinvest in residential property or put your money in government bonds in order to avoid that tax. So that money will have to go into bonds anyway, and then you can consider investing the rest of the money into equity. Also, take a look at the market around you. If you feel that the rate at which these these homes are going are too low, then give yourself at least a year to find a good enough buyer who will be able to give you a good value. Don't do a distress sale. It might not be worth it. All right, we're going to have to wrap up this show. Quick takeaways. Not a great market to sell property, but equity seems like the most attractive investment option right now across the board, whether compared to real estate or to gold or to any other kind of investment. So keep equity in mind and keep it in your portfolio. Dhirendra, thank you so much for joining us on Investors Guide and answering our questions. We're going to wrap up the show right now. Our contact details are on the screen. Thank you for watching.